Alphabet is out with its numbers now. The cloud number, which we had talked about being so important here, does look like it's a little bit light of estimates, although numbers overall beat estimates. Let's run through them. First quarter earnings per share, $2.81. That is 80 cents above analyst estimates. Revenue coming in at about $90.2 billion. That's above the $89.1 billion that was estimated by analysts. And that cloud revenue number at $12.26 billion, a little bit shy of the $12.32 billion that analysts had been estimating. But overall, revenue ex traffic acquisition costs, which is the measure that we look at for Alphabet's revenue most closely, $76.49 billion. That is ahead of about $75.4 billion that analysts had been anticipating. I also want to mention ad revenue here because there's been all of this concern about, are we going to start to see, Google, like many of these companies we talk about in big tech, are not necessarily directly affected by tariffs. But if there is a decrease in ad demand or demand from businesses in some way, would they see it in advertising? They're not seeing it yet. Ad revenue at $66.89 billion. That is also ahead of estimates here. So that's something to keep in mind. YouTube ad revenue pretty much in line with estimates here as well. And the company is announcing some cash return to shareholders, a 5% increase in its dividend, and an increased buyback authorization of $70 billion worth. So pretty sizable addition to that here. The company's first quarter capex, should mention, $17.2 billion, which was also pretty much in line with estimates. I'm still waiting for the release itself to kind of update here to get some color. But just to get some instant reaction for you guys, Mark, I know you had some pretty big hopes for what we might hear from some of big cap tech. In the case of Alphabet, they seem to have delivered.
Look, Alphabet has had 8 straight quarters of revenue beats and make this number 9. So It's pretty impressive that they continue to operate at a very high level. 281 versus 201. We haven't had time to dig into the numbers all that much yet, but that's a pretty impressive beat on the, looking at not only revenues and earnings at a time when arguably the market made a short-term minor breakout today. So being that Google is 5% within QQQ, given the A shares and the C shares, I mean that's pretty encouraging, I think, for potentially what futures could do as a result of this.
Yeah, it's interesting to see sort of the 5% pop off these numbers, because I think one of the big questions with Alphabet, just reading through different analyst commentary on the street ahead of the release, was there was definitely a growing fear that maybe the numbers come in line or potentially even miss. It seemed like some of those whisper numbers were actually lower than sort of what consensus estimates were. And so I think when you sort of make sense of how the numbers came in versus that, it's a good read. Also, Julie, you had highlighted that CapEx number. And to see the CapEx number slightly above expectations versus being below, right? Of course, CapEx being a big part of what we're talking about with these companies. I don't think we got CapEx guidance yet. No. I think that comes on the call. Yeah. And that's sort of kind of the looming big question here, I think, right?
We'll
is if CapEx comes down later this year from what they were prior.
And one of the other big questions around Alphabet, around all of these big cap tech companies, is how are their customers using AI? Are they paying for it? What are they doing with it? We got a little bit of commentary around that from CEO Sundar Pichai here in this statement. He talked about search seeing continued strong growth. It was boosted, he says, by engagement we're seeing with features like AI overviews. He says that has 1.5 billion users per month. It's funny, AI overview. I don't know that I ever opted into it. It comes up every time I Google. So I guess that's why it has so many users per month. But he also says YouTube and Google One have surpassed 270 million paid subscriptions. So that's something to highlight as well. So interesting here. Again, on the call, we'll get more color around CapEx and around AI and what's going on there. I want to start with Alphabet here because this is the one that we are seeing move higher after the company came out with estimates, with earnings that beat estimates by a pretty wide margin, revenue beating estimates as well. Gil, I want to start with you here because we did see these numbers very strong. The cloud revenue number may be a little bit light, but it doesn't seem like investors are perturbed by that. What did you make of it?
Well, there's two things to like. One is the search business is still growing. That's what we're always bracing for here with Google. We know that everybody is now ChatGPTing instead of Googling. So there's this expectation that we're going to fall off a cliff. That may not happen until ChatGPT and OpenAI start selling ads. So for now, the digital advertising dollars are continuing to go to Google, backward looking. That looks great. The other thing to really like is how much Google has cut costs. They beat on the bottom line by the most. And that's the relief that you're sensing here today, even though the cloud, let's call it, was in line, which again is a deceleration from last quarter, which was a deceleration from the quarter after that. So what we like is search still growing, very profitable, even though cloud was just in line.
And Gil, what do you think about the regulatory overhang that most of these companies still have to go through and the antitrust concerns? Is that something investors should still be concerned about?
Absolutely. The Department of Justice is hell-bent on Google not having a monopoly going forward. So breaking up the 3 monopolies that it says Google already has in order to prevent Google from having a monopoly going forward with chat. So instead of Google dragging its feet, which is what it's been doing so far, we think Google would be better off being proactive, spinning off these businesses. It would probably release value to shareholders, but it doesn't look like that's what they're doing. It looks like they're going to fight back, drag this out, which is going to continue to be a drag on the business.
Angela, I want to bring you into this and circle back around to search and ChatGPT's role in search here, or those AI summaries, because as I mentioned earlier, the company bringing up how many people are using those AI overviews, 1.5 billion users. But as I said, it just comes up when you Google. It's not like you opt into the thing. So I wonder how much added value that is bringing and how much that is really sustaining growth in search.
Yeah, no, so I think that's a great question. And, I think it's definitely going to get asked on the call, and analysts are going to want more clarity in terms of the AI monetization across Alphabet's overall business, right? Whether it be AI overviews, which is, a clear emphasis of this company here over the last couple of quarters, especially on the search side of things, or whether it be, Gemini across its ecosystem and how they can monetize Gemini. But, our view as far as search is concerned is, and the numbers were, really good in our view. You're talking about growth of 10% on a top line basis for search as well as on YouTube. So it looks like at least in Q1, the advertising side of things looked fairly healthy. We'll see if that can hold up through the rest of the year. My guess is you're going to start seeing some deceleration across the advertising landscape as we progress through the year. So we'll kind of see how that plays out. But ultimately, we do think they're going to find ways to monetize this stuff. We want to see, where AI overviews plays in terms of the role here. But at the end of the day, I think, search here looks pretty good.
So let me ask you, Angela, so a lot of these companies have reaffirmed their CapEx. We heard from Alphabet. I guess we'll know more at the call, but both Amazon and Alphabet seem to be very positive and really ignoring a lot of the effects of potential tariffs. Is that your view, that these companies are sort of just keeping their eye on the ball, and can they afford not to be more pessimistic about what's happening, or do you think they're still doing the right thing?
I think the opportunity right now is too great for you to kind of take, the foot off the gas on the AI side of things. So I think Alphabet earlier this month did reiterate their $75 billion CapEx plan. I think you're going to hear them reiterate it again here on the call. I don't expect any change whatsoever in terms of some of these hyperscalers for 2025. I think where the issue is at hand is clearly as we go into 2026 and beyond. I think that's really the risk for many analysts in the street out there. And literally, I think, what's going to be important here is the digital ad side of things, right? If that slows or rolls over here over the next couple of quarters because of macro uncertainties, the street is going to get very concerned about the sustainability of CapEx going into 2026. And that's where you get the fear of potential cuts. And that's where it potentially kind of rolls over into areas like semiconductors and provides downside on that side of things as well.
And Gil, I'm curious how concerned you are about that aspect, right? If you tune into Yahoo Finance or really anywhere over the past several weeks, it's tariffs, tariffs, tariffs all the time. And we see that in a lot of the survey data. We see it in polling. We see it as a concern. And so is it inevitable that a company like Alphabet is going to feel a hit from ad revenue at some point?
It is inevitable. The consumer was slowing down, let's not forget, before any of this stuff happened. Then we piled on DOGE, which means a lot of federal employees are going to lose their job. Then we reduced immigration, which was a driver of consumption as well. And then we put in tariffs, which is going to create some ripples in the economy, even if we don't follow through with new tariffs from this point on. So none of that is reflected in the backward-looking results. We're already hearing technology companies say, so far things are good, but we know and we feel that things are slowing down. You're especially hearing it from IT services companies that are saying their projects are being blocked, their projects are being held. And advertising is relatively early cycle. So once all these brands and companies realize that the consumer is slowing down, the first thing they do is pull back on advertising spend. That's why the March numbers are almost irrelevant for advertising. It's what are they going to say going forward? And they may not even know. I mean, we're just 3 weeks into this tariff conversation. They're likely to be more cautious on that, and they're likely to be even more cautious next time. And to Angela's point, I'm not signing CapEx data center deals into 2026 with this level of uncertainty. None of these companies are. They're going to follow up on the commitments they've already made for this year. They already have the construction in place. They've put in the orders. But to take on new investments with this level of uncertainty, highly unlikely.
So let me ask you a question. I mean, the stock was already down about 20% from all-time highs. So at what level would you say that the uncertainty is already very much priced into the stock? You know, it seems pretty compelling. They continue to beat numbers every quarter now, 9 straight quarters. I mean, it seems like the stock technically has started to really make a move for the upside. Is it right to continue to concentrate on those concerns, or do you just think the company has it figured out?
As long as Google stays as one company, it will continue to trade on its most at-risk business, which is search. Again, we are constantly in fear that those results will fall off a cliff as chat migrates traffic elsewhere, which will bring advertising revenue elsewhere. The best thing Google can do is lean into what the Department of Justice asked him to do and spin off these businesses. Waymo will trade like Tesla. YouTube will trade like Netflix. Google Cloud will trade like a high-growth software company at 10 times revenue. Right now, they're holding all this value hostage to a business that is very much at existential risk.
Really interesting there, Gail. I want to turn to Intel because there obviously is also a really fascinating story here. And Angelo, we'll get you to dig into Intel here for us. The company is confirming that it is cutting some jobs, removing management layers in the words of CEO Lip Bhutan. But what I keep coming back to is this is a company that still is just not delivering what investors want. When will it be able to do that?
I mean, I think the quick answer is that not in the next 2 years, and maybe never, right? So you kind of look at the company here, they've really kind of missed out on the AI boat. I mean, the world has completely changed over the last 3 years. They didn't have the right products out there. The emphasis was on manufacturing. It was on building, that foundry initiative out there, and not necessarily, the end of the world or something that's not going to come to fruition. But when you kind of look at them kind of missing the boat on the AI side of things, it's going to be almost impossible for them to catch up here, given the competitive pressures out there, specifically in NVIDIA. So when you kind of look here, what they're essentially kind of caught now doing is continuing to lose market share in the core data center side of things, and probably also on the PC side of things, as you've got new emerging competitors on that side of things. And ultimately, what they're going to have to continue to do is continue to right-size the cost side of things, right? So you saw a 15% cost reduction last year. You're going to see more cost reductions this year, and they really do need to, at this point in time, if you're Lip Bhutan, you need to focus on kind of getting to positive free cash flow, and that's going to mean doing a lot of hard work on the cost side of things. And right now, Street's looking at that happening in 2027, but you need to see that happen quicker.
Yeah, it seems like there's only so much they can do, right? They're cutting 20% of the workforce, and they're going to do all they can to cut costs. But if they've missed the AI boat, I mean, what steps can they do to participate and regain leadership again? I mean, it seems like the stock has been range-bound for almost 8 months now, right near $20. What can they specifically do to change that, in your view?
I mean, I think the hope is eventually you kind of build up some business on the foundry side of things, right? You're moving to 18A here in the second half of the year into 2026. Trump is almost kind of giving you somewhat of a gift here by essentially throwing tariffs on semiconductors at some point later this year. So the hope is they get some sort of momentum and upside on the foundry side of things, and ultimately the hope is maybe you could spin off that foundry business, and then you can unlock the potential the margin side of things on the product side of things. But again, you need to have some of those right products here be developed over the next 18 to 24 months.
Well, Alphabet and Intel reporting first quarter earnings just a bit ago. Joining us with some takeaways, Yahoo Finance tech editor Dan Howley. Hey, Dan, where do you want to start?
Let's start with the bad news first, and then we'll go with the good news, right? The bad news is Intel. Obviously, they beat on the top and bottom line. Good for them. Now the bad news. We'll give it a compliment sandwich here, right? One of the bad news is the weak second quarter guidance. They estimate between 11.2 and 12.4 billion for the second quarter. Wall Street was looking for 12.8 billion, so big swing and a miss there. The CFO David Zisner basically saying the current macro environment is creating elevated uncertainty across the industry, which is reflected in our outlook. Now, there is some interesting news here. We'll go with that compliment sandwich. Now, here's the good stuff. Foundry did better than expected. The Foundry for Q1 brought in, 4.6 billion. Analysts were expecting 4.3 billion. Data center revenue also came in better, 4.1 billion versus 2.9 billion. And they beat on the client computing side, which is sales of laptops, desktops. Here's the bad news now. That beat, that 7.6 billion for client computing versus the expectation of 6.9 billion. The thing there could be that people started buying up new computers just before the tariff deadline. And so that means the second half of the year, it might be, not exactly bupkis, but, not great.
Right.
And so, that's the outlook for Q2. That kind of helps to drive that. And then what's that going to mean for 3 and 4?
Yeah.
Obviously, this is a company that's trying to reinvent itself. Lip Bhutan, the new CEO, has said, look, made mistakes. We're going to try to fix things. They're cutting on CapEx. They're going to lower headcount. And they said they're going to kind of squash some of the management levels to kind of even things out, they say. And then, obviously, Alphabet. Good news, basically.
Yeah, and they also had a big buyback, which maybe we didn't talk enough about earlier, but they did have that, as well as beating numbers.
$70 billion stock buyback authorization. They've raised their dividend by 5%, beat on the top and bottom line. I think one of the things, let's go with that compliment sandwich idea again. One of the negatives here is that cloud actually missed by a hair, 12.2 billion versus expectations of 12.3 billion, but advertising came in at 66.8, higher than 66.4. And we had also seen, obviously, EPS beat. It's basically a company that everybody's wondering what's going to happen with data center sales going forward. Are companies going to start to pull back? Now, Q1, obviously, no one was really thinking about that. I mean, I'm sure it was on people's minds, but it's not as reflective as what we saw with Intel with that big kind of, everybody going out and buying up all the laptops, kind of like toilet paper during the pandemic. Yeah. But this is, this could be reflective later on as we start to see, people started cutting as tariffs came out. Now we'll see it in, Q2, Q3, Q4. It's still up in the air. Who knows what's going to happen with tariffs? I feel like every few seconds it's, on, off, on, off, on, off. It's Ross and Rachel, right? Right now they're on a break, I guess. So we'll have to see what happens in the next few quarters, though. But for Google, good stuff all around.
The tariffs are Ross and Rachel.
Yeah. That was off the dome, right?
That was pretty good. Thank you for that, Dan Howley. That was pretty good. Thank you so much. Intel is what we're talking about here. The company is confirming that it is making some changes to personnel, and its numbers are missing estimates pretty much across the board here, particularly when you're looking forward. Adjusted earnings per share in the first quarter did beat estimates. It looks like adjusted earnings per share at 13 cents. Analysts were looking for nearly break even on that basis. Adjusted gross margin in the first quarter, 39.2%. The estimate was for 36.1%. But the second quarter forecast is for revenue of at most $12.4 billion. Analysts had been predicting $12.9 billion. And here, too, I'm looking at this statement. Lip-Bu-Tan, the CEO, who's just been in place for about 6 weeks or something. And he talked about the first quarter being a step in the right direction. But he says, quote, I am taking swift actions to drive better execution and operational efficiency while empowering our engineers to create great products. And then they talk about in the statement here, streamlining the organization, eliminating management layers, and enabling faster decision making. So the company's cutting its non-GAAP operating expense target to about $17 billion this year. It had been $17.5 billion that they were targeting, and they're targeting an operating expense target again on a non-GAAP basis of $16 billion for 2026. So really focusing on this efficiency, trying to right the ship here. But it is interesting, investors in Intel have already been so very patient, right? They waited through the Pat Gelsinger era for them to turn things around. Now they've got a new CEO. How much time are they going to give him to now turn things around? Judging from the reaction here, maybe not a lot.
Well, as I like to talk to investors about, look, it takes a long time to take a stock that's at 52-week lows and think that it can immediately start to climb back. You have a well-respected leader like Lip-Bu-Tan from Cadence, and so he's executing his own version of DOGE now, not only with employees, but also expenses. So I think there's reasons to be encouraged in terms of cost-cutting steps and things he's doing to try to turn things around, but it's going to take time. I mean, Intel is a classic underperformer and a real laggard within the space, and for those that are looking for immediate results, you don't get rich trying to buy dips. You buy things that are at or near highs, and stocks like NVIDIA, which have led all of the semiconductors outside of TSM and Broadcom over the last 12 months. So those are areas that make a lot of sense for me. Intel, it's going to take time. There's nothing, my thinking is it's difficult to put a lot of money into a stock at historic lows, and you just have to be very, very patient, unfortunately. And that means you have to wait till the stock almost gets above 24, and you have to wait until you see real proof, and then you can start to put more money to work.
And Julie, it feels like a couple times over the last couple quarters, I feel like we've been talking about this name after earnings. We talk to an analyst, and they say, not quite yet on Intel, right? I'm talking about chip-specific analysts, right? They're always sort of saying, well, that's probably a story that might materialize a year or two down the road, right? And so I think we're just quarter after quarter continuing to see that and essentially confirming that whenever the turnaround story is fully happening, yes, they're starting the process now, but we're just really not quite there, right? And it feels like it's something very off in the distance and in the future that isn't quite tangible yet. Obviously, they're trying to restructure. You can see the efforts going on, but until you get a little bit more tangible evidence, to Mark's point, it feels a little bit hard to get excited about the story overall.
All right, we got the numbers here. So earnings per share coming out at 27 cents. That's below the 43 cents that had been estimated. Our revenue coming in at $19.34 billion. The average analyst estimate was for $21.37 billion, so missing pretty significantly, especially on the earnings front. And some of the other things that we're seeing here initially here, some comments that the tariff landscape will have a larger impact on the energy unit, that the company is going to revisit its 2025 guidance in their second quarter update. That is not particularly unusual right now in terms of what we're hearing from companies. Tesla says it's difficult to measure the impacts of global trade policy, but that things will stabilize in the medium to long term. The company also says that its plans for new vehicles is on track to start production in the first half of 2025, so still on track for that, we'll see. And that there is sufficient liquidity to fund the product roadmap, but the uncertainty could affect demand in the near term here. And it looks like there is not a return to growth forecast in this earnings report. So we'll see what kind of color commentary we get on the conference call related to that.
Yeah, and going along with some of that tariff comments here, Julie, going just through the presentation here, company talking about automotive energy markets continue, uncertainty continues to increase as a rapidly evolving trade policy adversely impacts global supply chain, cost structure of Tesla and our peers. This dynamic, along with changing political sentiment, interesting for them to call that out within the statement, within their presentation itself, could have a meaningful impact on demand for our products in the near term. So pretty forthright commentary from the company here around the challenges facing the business. Now, I know I just gave a preamble about how the story is really about what Elon says and buying his worldview, and the company has generally viewed commentary to this effect, I would say, as, again, very Wall Street, very numbers, you're not seeing the big picture. But I think for Tesla to come out and be pretty forthright about the challenges facing the business at this point in time, and you look at a miss of the magnitude we're looking at, a change in tone, I guess I would say, is a different sort of release, I think, from the company than you are typically want to see if you go back through the quarters.
The changing political sentiment really does pop out, right? Because when you think about sales not being as strong to start the year, right? Of course, disappointing, and really just a large part of that story, as we were highlighting a minute ago, we know that people are not that excited about Elon Musk's involvement in the new administration to the point that he's been involved. We've ran several survey datas, right? We've been covering this for the past couple months of people just saying that they're less interested in buying Teslas. So then I think my question is sort of spinning it forward, because we keep on saying how it's really kind of all about the call with Elon. To what extent is he willing to talk about this, to maybe address any level of what does changing political sentiment actually mean? Are they aware of sort of how consumers are now changing their views on the company, and is that part of their actual calculus moving forward and something he's sort of considering amid all of this?
Yeah, and it also highlights, once again, the bizarre position of the world's richest man and head of one of the world's biggest companies being in this position in an administration with which he is at odds regarding trade policy. Clearly, everything that is in this report indicates that trade policy is not good for a company like Tesla, even though Elon has talked in the past, yes, they assemble or build their cars in the United States, but he is, he's at loggerheads with Peter Navarro, the trade advisor to the president on this issue. And again, it highlights the perils of being in the private sector and yet being so close to the political realm, not just for the actual political ramifications, but if what the administration is doing is against your shareholders' interests.
It's a challenging position because what Tesla said in the release is materially the same as what most companies are going to say versions of in their release. But to your point, Julie, most companies do not have their chief executive, in the Oval Office many days.
Yeah, so exactly.
That's a big difference there. Also, the stock's doing nothing, which is fascinating to me. I'm sitting here looking at the stock like, what are we doing? I guess we're going to wait for the call. Down 1%.
Maybe people are waiting for the call?
I suppose is fine.
It seemed like coming into the
market
report,
pricing
though,
an 8% move, something like this?
Yeah, but didn't most people coming into the report think that the
Stock's
report
down
was
40% this year?
Yeah, no one really thought the report was going to be that good anyway, right?
That's
So you get a not good report, and kind of what do you do with these numbers again until you hear, I think, some larger questions that people want to know from us in the call.
There was a lot of commentary going into this that this would be a sort of reset year for Tesla. That it's not that the first quarter doesn't matter, in the words of Adam Jonas of Morgan Stanley, but it is more that you now have to sort of reset and look past this and see what happens next. We've been talking a lot today about what we're going to hear from Musk on the call in terms of his role at the company. You have said very firmly, DOGE needs to go in terms of his focus. He needs to come back. Do you think we're going to get that today, Ross?
I do think we're going to get that. And I think we're going to get that also because his special government employee designation ends anyways at the end of May. So it's not like this is new information. I think he's just going to make it very clear. He's going to try to do anything to get the stock not to go lower. So he's going to say he's coming back to Tesla and he's going to be done with DOGE and he's done his work and he's solved all these problems. And now, I'll be back. And that's, I think, the message that people want to hear. And that is probably the only thing that could get the stock moving higher. So I expect to hear that.
Ross, as you look at the stock slide over the last few months now, 40% drop. We've had multiple periods like this in Tesla's history. How do you think this period, is it analogous in any way, I suppose, to prior drops? And how have you thought about the story as we get towards what feels like a pivot point in where it's been over the last 6 months?
People aren't going to like this statement, but Tesla is fundamentally a different story than where it was several years ago. I mean, Tesla was a massive growth story. It was a young, amazingly innovative technology company building cars. and software. And now Tesla is a very mature EV maker with a CEO who doesn't work there, who says horrible things about lots of people that won't buy their cars anymore. And the biggest issue Tesla has is people just don't want their products, even though they're the best products in the market. So I don't know how they solve this. So I think Tesla's best days are behind it at this point. And until something really changes in the direction and or leadership at the company, especially with the board of directors, to try to get the company back on track, I see sales continuing to decline, and with that, revenues, profits, and everything else. So energy storage can only save you so much, which it did save them in the quarter because that's been a very strong part of the business. But automotive sales were just dismal.
What about all the other stuff, Ross? All the other reasons that people own this stock, right? The cheaper car that is supposed to be in production by the end of the first quarter, the robo-taxi, eventually the humanoid robots, the AI piece of it all. Is all of that enough at this point?
Well, when you're an investor, you look at the future and you have to try to model out what that future looks like economically. And so obviously a lower priced car was the most sensible thing that Tesla could have built, and then they didn't build it. And now I don't know what's happening with this, but I don't think there's a lower priced car. So let's just move on from that. A lower priced car is actually just a used Tesla, which you can buy for $20,000 or so online right now. So if you want a low priced Tesla, it's called a Model Y. Just go buy one. They're all online, used. They're great cars at a ridiculously cheap price. Then you have another problem because then there's so many used Teslas for sale, they have no reason to buy a new Tesla except it has a light bar on it. The light bar on the Model Y and the new Model Y is very nice, but is it really going to convince a whole new legions of buyers when they don't even advertise? No. So then you've got robots and the future of cybercab. And the cybercab business is not a business I want to be in because I think it took Uber forever to make money. And now you've got Waymo's, and I'm in an area where Waymo is very active, and I watch Waymo's drive incredibly well every day while my full self-driving still is this clunky, software driving like a 12-year-old. And so I'm really upset that the software doesn't work and it's not even comparable to Waymo. So Waymo's expanding all over the world now, and I just don't see how Tesla catches them. And Waymo's got money. And then lastly, I just don't see a world anytime soon where we have robots walking around and doing our laundry and stuff. So if you can tell me when that's going to happen, that's how long it's going to be till Tesla makes money. Well, that could be 5 or 10 years from now. So I don't know about you, but I got to make clients money every year. And Tesla just doesn't seem to be doing what it needs to be doing.
Ross, you raised an interesting point about the cost of the car, because I know a lot of people who have been in like that, let's call it like that Audi, BMW sort of market, and they get a Tesla because it's a whole lot cheaper than those kinds of cars. But I think for a lot of people, it was sort of associated as like a luxury vehicle. Now, the company's been very forthright. They wanted lower cost cars. They make lower cost cars. You can get lower cost Teslas. And I'm just wondering if there's like a timeline here upon which the strategy starts to look more at premiumizing the brand rather than this mass appeal, mass robo-taxi networks, all those sort of things that have defined the company in the last, I don't know what it is, 4, 5, 6 years.
I would argue that Tesla was a premium brand when it started, and it's, and I was worried about this many years ago, it looking a lot more like Toyota in the future than Mercedes and BMW. And that's what's happened, is it looks a lot more like Toyota now, and people don't consider Tesla a premium brand anymore. And so, the mass appeal brand works if everybody likes your brand, but if everybody hates your brand because your CEO supports like right-wing Nazi parties in Europe, it's really, really hard to sell cars. And so when you want to have mass appeal, I highly recommend that you act in a way that appeals to the masses. And so I'm not sure what Tesla is anymore. It's certainly not a premium brand anymore. I wouldn't consider it a mass brand because most people actually hate Tesla now. It's probably one of the most hated brands that I've ever seen, and it sucks. It's really sad that Elon's allowed this to happen to the company. So I'm not sure what they do with their brand moving forward, and I don't think they can be a premium brand, and nor are they focused on the premium market. If you look at a Rivian or a new Mercedes or BMW EV, they're so much nicer than Teslas.
Ross, every time we talk, we ask you if you still have the stock, either yourself or on behalf of clients. And you it feels like you hold your nose and you just hold on to it.
Well, it's more the opposite. We acquired a lot of stock in the old days. We've owned it for 11 years and we've made a ton of money off of it. And for the last almost 3 years, we've been selling the stock. But it's really hard to sell, $100+ million worth of stock, easily. And there's a tax consequence that we've had to accept with that. And so I had a lot more hope than I have now that Tesla would right the ship. But now I think it's real tough and for them to fix the ship now. And so long term, I still think Tesla has the best products. I think climate change is the most important issue that humans solve over the next 10 years. Tesla makes the best EVs, the best software for EVs. It makes energy storage products, the best charging experience. And if they focused on this, they could be wildly successful. The EV market in the United States growing 10% or more. EV market globally probably growing 25%. This is a great business. There's nothing wrong with it. So I have in this hope that either a new CEO takes over and fixes the brand or Elon somehow changes or something, but my hope is running thin. And so, we end up selling the stock every week. We'll sell stock for clients depending on each client's situation. For many of our clients, they don't want to own Tesla anymore. So our position is about 40% of what it used to be. And we continue to whittle it down. But many people, our clients, very much care about climate in the future, and Tesla's still the best solution.
Russ, you talked about that possible executive change, I guess, get a new CEO. Is there I know Elon, has the comp package and has his control of the board and all that. Is there any scope on which a serious activist push could be made with someone who has enough capital in the stock that you could get movement? And I can see you kind of shaking your head here.
No, I kind of tried that in 2023 when I ran for the board, and I did get a lot of institutional support at that time. And one of the things I realized is there's no way that Elon's letting anybody on this board that isn't on his team. And everybody on the board is more than bought and paid for by Elon. And I realized what a mess I was getting into. So that's why I pulled out, because I just didn't want to be involved anymore, because the politics around that board is pretty bad. And so, the fact of the matter is that, right now, unless the board of directors is sacked, nothing's going to change at Tesla. And that's what needs to be done. And I think the attorney general, in California, should be suing the board of directors of Tesla for negligence. And that's, I think, the next step for many of these institutional shareholders and pensions, for the damage that's been done to the pensioners from a lack of board oversight and violation of NASDAQ rules. So I think, the board needs to be replaced immediately. It's probably the worst board in the history of American business.
Wow, that's saying something, Ross. All right, well, as always, it's good to catch up with you. We appreciate you chatting with us about Tesla. Thank you.
Yeah, thanks for having me.
Jessica, we have been talking remarkably little about Tesla's core business during this discussion because we've been so focused on DOGE, we've been so focused on the robot comments, et cetera. But Tesla's core business, in a word, is bad right now. And is there anything that you saw in the report today or that you were starting to hear on the call that gives you encouragement that things are going to get better?
I mean, not necessarily. We haven't seen a lot of metrics. Obviously, when their delivery numbers came out for the first quarter, they were underwhelming. And I don't think it was necessarily a surprise that they were underwhelming, but it doesn't really bode well for the rest of the year, considering in terms of actual product, there's not really a lot out there. Are they going to have this lower price vehicle? What exactly is it? Is it going to be a decontented Model Y that maybe people won't find as appealing? That's a big liability right there. So when you think about Tesla, their core business is selling vehicles. And right now, that's probably the basic that they need to get back to at this point in time.
Jessica, something I'm really curious about that I still don't feel we have a good answer to is we know that Tesla's sales dropped. We know that there was probably some mix of the Model Y changeover effect, people waiting for a new Model Y, and the political and brand damage. But is there a way of telling how much of each that is? Do we have any insights on how would we start to try to figure that out?
Well, I was looking at metrics. What I did see over the past few months is an increase in Tesla trade-ins. So more people are trading in Teslas for other vehicles than they have been at the past. So that means, you hear about people dumping their vehicles. It looks like we're starting to see a little bit of that. And the other thing that I think is pretty concerning as well is that when I look at our site traffic people that shop other electric vehicles like the Chevy Blazer or the Honda Prologue, they're shopping Tesla models at a much lower rate than they were in the past. Before, it was like if you're looking at an EV, you're also looking at a Tesla, and that is not necessarily the case any longer, which could be, extremely damning for Tesla as they move forward in time and more EVs come on the market.
Hey, Jessica, this is Jay. I want to try to spin some positive out of that call because we are focused on all the negatives. Was there something that stuck out to you as new news or a positive spin that some analysts may come out tomorrow and focus in on besides the DOGE factor and the lack of certainty with tariffs?
Well, I mean, I think that he was very clear about some of the timelines for the robotaxi in Austin. It seems like he was like, this is happening. Of course, people were thinking, is it actually going to be one of those things that keep getting put off and put off and put off further down the road? It seems like that's clear because we're in April. It's almost May. That's literally next month. So not to make that timeline would seem not, in the best interest of Elon Musk at this time period. And the fact that he is talking about, he was not very specific about his DOGE step down, but at least he had said by next month, I should be able to focus a little bit more, and maybe 1 to 2 days per week sounds like a lot to me. But it is not a 24/7 job anymore. And perhaps he can focus more on some of the core business of Tesla.
Jessica, asking about the robotaxi here, we've seen obviously Waymo operating in a number of cities. What's your sense of what the demand is for that kind of service and what the demand might be for a Tesla robotaxi service?
Mm-hmm. Well, there was a lot of just concern. Would people actually want to get into a taxi that no one is driving? And it seems like it is something that people are growing increasingly more comfortable with, especially in places where they see a lot of them. I'm in Los Angeles. It is very common to see them out on the road. It feels like people were very skeptical in the beginning, and now it is catching on. So it does seem like something that is going to pick up, in pace and demand. And I think people like this concept. They like the novelty. They're interested. They like to tell their friends. They like to talk about it. So I think from that vantage point, it is good. It's just that Tesla has to join this market. Waymo, like we had talked about, is far ahead of them at this point, and that is what people know. Tesla coming to market is they're late at this.
Jay, you want to?
Yeah, I just there's so many different things to talk about. But did you take anything away from China? He really didn't. When we were listening to the call, I know the call is still going on. To give us anything to say that the relationship is going to be good. He was concerned about it. That was one of the biggest questions investors had coming into this. What is your biggest concern about China going forward based on what we've heard so far on the call?
Yeah, I didn't hear a lot about that either. I think I wasn't listening at that portion. But I will say that's such a big concern moving forward for these battery electric makers. So much of the componentry, the mining, the cleaning of the minerals, all that, the processing, happens in China. So when there are roadblocks there, that's going to affect everything. And as these companies don't have access to those things or the prices increase, that is going to affect the market greatly. We're having an affordability crisis in the new vehicle market right now. Vehicles are expensive. They're getting more expensive because of the tariffs. Now they're getting more expensive because of these mineral costs or steel, aluminum, all of those things. We could get to a point where there are so many people out of the market because they simply can't afford it. And it's not really a place that any automaker wants to go to, but it is a concern right now.
So Jessica, we've been focused so much on Tesla. I mean, I'm curious what other autos we have seen that have maybe picked up some of the slack from Tesla. I mean, we know there's not huge demand. It's not a booming market right now, but there is a market for new cars. So where are we seeing sort of more activity at the moment?
Mm-hmm. Well, I think if we look at some of their competitors out there on the EV market, it is a weird market right now because we're in the situation where people are almost panic buying because of the tariffs. So what we see and what we've seen over the past few weeks won't necessarily be typical for the rest of the year. But we are seeing people trying to get these deals. They want to get these vehicles before the tariffs are on. They think that, when the time comes, all of a sudden vehicles are going to get a lot more expensive. But when we look at some of their competitors out there, Hyundai, Kia, Honda Prologue, General Motors products, they're all things that people are considering and could potentially really take away from some of Tesla's market share. I mean, we saw just a few weeks ago, California market share dropped below 50% of the EV market for the first time for Tesla. That's big. This is the nation's biggest EV market. So the fact that there is that door of opportunity for all of the automakers is important, especially some of the startups like Rivian and the new one, Slate.
Yeah, and then lastly, you talk about sales. Sales have been declining. He's obviously been blacklisted by certain communities here in the United States. Where do you see that growth coming from now? Because we haven't been able to see it in auto sales. He didn't give us anything really to hang our hat on. Going forward, the next 3 to 6 months, do you feel as if we're going to have to wait for another quarter before we can get anything truly optimistic out of Tesla?
I mean, they've talked a lot about the Model Y refresh. It's just, it feels like it's hitting at an unfortunate time for Tesla at this point in time. There's a lot of people that are, may not consider it as much as in the past. And, it seems like from all accounts, a fairly decent refresh. So it doesn't necessarily seem like people are clamoring to this product or Tesla in the short term. It just feels like they sort of need that next big thing to really kind of restir the love affair with Tesla, because it's like when you think about their last product that was more for the mass market, the Cybertruck, that was pretty polarizing. People loved it, but a lot of people did not like it. So until they kind of get to that next product that would be more appreciated by the mass market, they're still kind of stuck with what they have. Yeah. And, we've seen already from the first quarter, it doesn't seem to be hitting as much as it once did.
Well, and Jessica, the Cybertruck, it may be a mass product, but it's an expensive product, right? So the other thing, of course, that we're waiting for is the lower priced Tesla. And there's been some reporting around whether, Musk said today they're on track, but there's been some reporting around whether indeed they are on track. There's been some reporting around whether it might just be a stripped down Model Y. Is that something that would be appealing in the market, or would it need to be sort of different enough from the existing Tesla models, even at that lower price point?
I think it needs to be different than the existing Tesla models. If you look at a stripped down Model Y, it doesn't feel like that would necessarily set the world on fire. If you want a cheap Tesla and that's what you're into, go get a slightly used one. The residual value hasn't been great on that vehicle. So if people are truly looking for that deal, it may be used by a few years, but you're going to get a great deal on it. So it does seem like there is something that has to be new, at least visually. These people are they need to connect with their emotions, with their eyes. And even though, we may be attuned to all the small differences of a vehicle refresh, the average consumer isn't. They need to have a visible difference. And it feels like that's what Tesla really needs to kind of move the needle for themselves. And I don't think that's new news. It feels like that's been going on for a while when you think about how long in tooth the Model 3 and the Model Y are.
Gautam, I'm going to turn to you first on this because you have written about Elon Musk. You've talked about most recently this sort of mistaken belief that we have that if an executive is good at one thing, even very good, even genius at one thing, doesn't necessarily mean that they're going to be good at everything they put their hand to. But Musk didn't sort of pull back at all from the idea that what he's doing at DOGE is good and right, and that it is a mission that he believes in.
Right. No, he didn't at all, and you wouldn't expect him to, given what we know about him.
Yeah.
I think the way in which DOGE is harming him, even apart from the sort of first level effects of, it makes him really unpopular with the people who are most likely to buy electric cars, is people are watching DOGE and seeing that it is not going well. Like his argument that he has done a huge amount of sort of eliminating waste, fraud, and abuse, it is just not true in the math. One of the things that I think the government might have been new to him is this is all public, and we can see that federal spending has not decreased. We can see that DOGE has done many things that even the Trump administration has to admittedly immediately reverse after they realize the consequences. If much of Tesla's valuation is the halo of Elon Musk, DOGE really dinged that halo.
And Jay, I want to bring you into this as well. Even if, obviously investors wanted him to focus more on Tesla, but if he is still associated with DOGE, can the brand damage be reversed?
Yeah, it's going to take some more time. He started off the call talking about how the protests have affected him and the company and how some of these were misguided. Some of them were, sponsored by outside forces. And then, when he got into DOGE, you want to hear, he said it's critical work and he wants to continue to do this work, but he's going to get back, and there was no exact timetable. Yeah, next
May,
month in
sometime,
May.
yeah.
Very casual and 1 to 2 days a week. You know, we want to hear a little more confidence as shareholders, as investors, that no, my time here is being well served, and now I need to focus back on what I'm doing with Tesla. And there was no real enthusiasm. He's not overly enthusiastic all the time, but he sounded tired, he sounded beaten down, and there was nothing timetable-wise that was concrete enough to watch the stock trade. I was watching the price after every comment. It peaked at 251. It slowly faded back. The stock is up more after hours because of that Jerome Powell news than what he had to say on this call.
That's a really interesting observation. Gautam, I want to focus in on something that Jay just mentioned, and that is Musk's comments at the top of the call, his allegations that he has presented without proof, that he has said before, that some of these protests against Tesla around the country are either people who are directly receive government largesse, who are upset that it's now going away, or who are directly paid by some dark forces. And you know, I guess this is why most CEOs aren't out there tweeting, especially not, you know, putting up conspiracy theories and whatnot, because it's not necessarily good for your business. So I'm curious what you make of. I mean, he led with that.
I think we can dismiss the accusations about them being paid if for no other reason than the protests are of such a scale that even Elon Musk could not afford to pay these protesters, right? So we could just toss that one aside. I think actually that if I were just judging him based on what he said on the call, if I were an investor just looking at the call, putting aside the track record at Tesla, putting aside his extraordinary what he's done at SpaceX, just listening to this CEO, I, as an investor, would say, no, really, I'd rather you stayed at DOGE. I wouldn't want you to be back at Tesla. Because this is a guy who was saying things, as you said, with conspiracy theories that bordered on delusional, disconnected from reality in ways that aren't really, signs of great management. I wouldn't bet against Elon's ability to return to Tesla and become a great CEO, but this was not evidence that he is.
Well, and Gautam, if it gets to the idea of credibility, I mean, okay, let's leave aside the conspiracy theories for a moment. Elon Musk does not have a wonderful track record of meeting targets, especially not in a timely fashion, but some of them not even at all. And so when he says we'll be coming out with a lower cost car still by the end of the first half, or when he talks about potentially having autonomous driving being profitable by next year, or thousands of Optimus robots in Tesla's factories next year, how are we to take those comments?
Well, I mean, you put your finger on it, right? If anyone other than Elon Musk were saying that, people would not even take it seriously. Let's break it down a little bit, right? On autonomous driving, Tesla is not the leader. Waymo is. If you're talking about assisted driving, Tesla systems are not the leader. Mercedes probably is. If you're talking about Optimus, the robots he demonstrated weren't even autonomous. I don't even know where Tesla is in the game of creating those kinds of robots. And the only line in their annual report that actually was good news, their power storage business, is the thing that is most vulnerable to Chinese pressure because they depend on Chinese lithium iron phosphate batteries. This is just a story where you have to believe this guy can work miracles, right? And then everything comes together. And if you don't believe that, this is not a story that makes any sense.
Yeah, thank you for mentioning Waymo. People forget that Waymo is active in 8 cities, at least in the U.S., and now going to Tokyo. And then I just wanted your take on him reiterating, by 2030, we will be the most valuable company in the world, possibly as big as the next 5 companies combined. I watched the stock do nothing as he said that. Last quarter he said that, and the stock did take off a little bit on that news. I just wondered your take on that.
I think you can only say things and not follow through on them so many times. And despite, right, I never take away from Elon what he did at SpaceX, right? What he did to get Tesla to where it is today. That's very real. But now what DOGE exposed over and over and over again was a person who made statements that were consistently in his own self-interest and had no ties to reality. That just doesn't lead you to confidence that he's going to get better in future.
We talked to Ross Gerber earlier, who bought into the stock on his behalf and on clients' behalf years ago, made a lot of money on it, and has been selling it off slowly. And he made the point today that Tesla is not the company that it was in terms of its growth profile. I guess if I'm an investor or a potential investor, What do I need to see at this point to show me that maybe that it is possible to get back to what Tesla was?
You need to see a Tesla board, and I don't believe you will see this, but you need to see a Tesla board that puts in people who are able to restrain Elon Musk's worst instincts and enhance his best ones. And so there is no such thing as the leader who operates at peak performance without constraints. That person does not exist. And Tesla has just allowed Elon to operate without constraints for an extended period of time, and the board is derelict in not stepping in and saying, no, whatever magic pixie dust you have been able to bring to the board, now you need other people around you who can tell you, hey, canceling the $25,000 EV, this is a really bad idea, and we're just not going to do that, as one example.
Yeah, and I was just curious your take when he talked about his relationship with the president. One of the things a lot of investors are out there, well, he's got the president's ear. He kind of backed down on his thought on tariffs. He treaded lightly on that subject. I just was curious what your take was. Did you expect him to be a little more combative, if you will, when it came to the tariffs on China?
I did not, partly because this is such a vulnerability for Tesla. But let me give you a movie quote that maybe, since Elon loves epic fantasy. There is only one Lord of the Ring, and he does not share power. Elon Musk is the wealthiest person in the world. He is the most powerful civilian in human history. But he is not the president of the United States. And the difference between the president of the United States and Elon Musk is vast. And I think he learned that the hard way when Trump rejected his advice on tariffs. That vulnerability that's been exposed is very real. And the idea that Trump is going to sort of find ways to channel money to Tesla of such an extent to justify the valuation that it has. We're not talking about like a few billion here and there. We're talking about tens or hundreds of billions of dollars. When the scrutiny on that is so enormous, when Musk has already demonstrated himself to be an enormous political liability in Wisconsin, it's kind of hard to see how that's going to happen.
Tesla getting several price target cuts following weaker than expected first quarter results. Automotive revenue down 20% year over year, while total net income was down 71% from a year earlier. Here with us now, we've got Stephen Gengaro, who is the Stifel Next Gen Transport Analyst. Good to have you here with us. You're bullish on Tesla, despite some of the warnings that we've heard from other analysts. How are you evaluating the company post earnings and what we heard from Musk on the call?
Yeah, thanks. Good morning, and thanks for having me. So when we look at Tesla, and we've talked about this pretty often, is the near term is going to be bumpy, and we have seen the data. We actually have a group within Stifel that runs these really good surveys on favorability ratings, et cetera, and we've seen this sort of significant drop in net favorability rating towards Tesla, and that clearly was a headwind for sales in the quarter, along with some other things. I think people speak a little bit less about on social media, but the reality is they were rolling over production on their most important vehicle, the Model Y, throughout the quarter. So that had an impact as well. And the results effectively were weak, but I think they were expected to be weak. When we think about the company, we look past the short term and really look at the story that's developing around full self-driving and robotaxi, and that's a huge part of the value creation for the company over time.
And I'm curious whether or not that forward-looking story that you talk about is still intact, given some of the branding challenges. Investor Ross Gerber spoke about those challenges with Yahoo Finance yesterday. Take a listen.
Tesla is fundamentally a different story than where it was several years ago. I mean, Tesla was a massive growth story. Now Tesla is a very mature EV maker with a CEO who doesn't work there. People just don't want their products, even though they're the best products in the market. So I don't know how they solve this. So I think Tesla's best days are behind it at this point.
Stephen, with that in mind, can you put the genie back in the bottle when it comes to Tesla's branding problem?
I think you can. It's one of the things we talked about in a recent report was we kind of look back at things like the Bud Light I don't want to call it scandal, but the Bud Light issues that they faced, the issues with Nike and Colin Kaepernick, the issues with Target for a short period of time when they had the whole transgender bathroom discussion, and kind of these things are sort of these corporate positions which can impact the companies, they can impact sales for a short period of time. And I think that's why the news last night that sort of somewhat expected, but the fact that Elon has talked about taking a lot more time at Tesla and a lot less time maybe in the public eye as part of the government, I think was so well received Now, the duration of sort of the impact of his involvement, clearly is hard to gauge, and how that kind of plays out from a sales perspective. In the world of X and social media, we kind of we hear the barbells on most issues, and a lot of what we hear clearly on Tesla has been negative from the far left, and cars getting keys and vandalized, et cetera. But the reality is they still sold a lot of cars in the quarter. They mentioned on the call the order flow on the Y, and the new Model Y has been very good. So I think this sort of does dissipate over time, but it remains a short-term headwind for sales.
It's interesting because you typically had, and just acknowledging that we still don't have the firm reporting on exactly who was behind a lot of the vandalism and everything that you were mentioning a moment ago. So just want to be clear on that. But all that taking place does have a longer term type of mind share kind of, it sucks up a lot of the attention in the room away from what the company is trying to do at the end of the day. And so how long does it take for Tesla to regain that or put that at the top of the list for potential car buyers? Oh yeah, at a time where buying a lot of vehicles right now is perhaps very expensive for many people out there who are just trying to evaluate if they're going to be able to use a tax incentive, and they're not going to be able to, it sounds like, in the near future.
Yeah, but it's interesting. Obviously you have the macro, right, which is sort of the economy, the environment, the consumer, inflation, et cetera, interest rates, and then you have the maybe the micro on the company side. The reality is they have been affected, right, and we see it in the data. And one of the really intriguing things that we saw in some of the data that we have is that the willingness of Democrats versus Republicans to buy EVs is pretty significantly different. Part of it's geographic, right? Because the charging infrastructure is more on the coast, and range anxiety and charging is kind of a big part of buying an EV. But the other part of it is a bit political. And what we've seen actually pretty interesting over the last 6 months, maybe 4 to 6 months, is the Republicans' willingness to buy a Tesla and the favorability rating has risen sharply, and the Democrats has dropped significantly, right? So are there enough kind of Republicans buying Teslas that's going to offset that? Probably not. But I do think that the impact of Elon's political involvement and the hatred we've seen online, et cetera, it will dissipate. Is it going to take a month? No. Is it going to take 2 years? That's probably not. So I think you'll start to see those buyers come back to the market. Yeah. I read something, I think yesterday, just about Tesla sales in California were still extremely strong, right, in the month of March when the new Y came out, right? So I think it's overblown. It has an impact, but I think it's a bit overblown in the media.
Now time for some of today's trending tickers, and we want to talk more about Alphabet and that possibility. Of course, we're looking at their earnings, but also there is this trial hanging over the company. Yesterday, we spoke to D.A. Davidson analyst Gil Luria, and he talked about the potential breakup of Google and why he thinks maybe it should happen.
The Department of Justice is hell-bent on Google not having a monopoly going forward. So breaking up the 3 monopolies that it says Google already has in order to prevent Google from having a monopoly going forward with chat. So instead of Google dragging its feet, which is what it's been doing so far, we think Google would be better off being proactive, spinning off these businesses. It would probably release value to shareholders.
So let's do a deeper dive now into Alphabet and Tesla. And guess what? We have an Alphabet bull sitting right next to me here in the form of Lou Bassianese. I want to ask you specifically about what Gil was just saying there, this idea that maybe they should get ahead of it.
Wholeheartedly disagree. Why would you give up your assets willingly or spin them off? I mean, I think in this case, the sum of the parts is not better separated. It's part of the whole. I think you create more consumer confusion than encouraging competition if you divest Chrome. I mean, let's be fair. What other search engines are you going to use? I mean, it's so embedded and entrenched. It's synonymous with the word search. Is there really going to be an upstart that does it differently?
Well, right? Maybe there wouldn't be another search. Maybe the search paradigm just changes to generative AI, for example? In other words, maybe it's not another search quote unquote company, maybe it's Perplexity, or maybe it's ChatGPT.
But I'd argue that'll happen with the natural evolution of AI, right? This becomes the next S curve of innovation where search is now it's the waning end of it, and we're going to jump to generative AI, and it doesn't matter, right? So from that standpoint, from a shareholder standpoint.
From that standpoint, I guess you don't have to break it up because there's competitive pressures coming anyway.
Exactly. And so I think from that standpoint, I think that's why the stock is so cheap. I mean, relatively speaking, it's at about 17, 18 times forward earnings. A year ago, it was at like 26 or 27. It's this threat of being broken up, being forced to not pursue the dominant position that they've had and having that protected. I think this latest report showed exactly why you want to own it, right? AI is contributing to better advertising results, which will lead to, even in uncertain economic times, marketers continuing to spend on marketing, which is just
You
a
don't
benefit.
think ad spend is going to pull back?
I mean, ad spend ironically always pulls back in a recession, which makes no sense. Like if you have a business and advertising drives your business and you know you're going to a weak spot, why are you going to stop advertising, right?
You don't have as much money.
I agree with that, but I think it has to be moderated. So I think you see an overreaction traditionally. Like I used to traditionally think of Meta as a great short in a recessionary environment because 98.9% of the revenue was all advertising, right? And people cut back. So yeah, I think there's some risk there, but I think what you're doing is you're counterbalancing that risk with AI improving results.
Gotcha.
So if I think that I'm not going to make as much, but then I can use AI-based search to make more, I can bridge that gap. So.
And you own Alphabet.
I do, full disclosure.
All right, let's talk about a stock that you do not own, I don't believe.
I do not.
And that's Tesla. It did surge as much as 10% today. The Department of Transportation rolled out a new framework for self-driving car regulation, including what it's saying is streamlining some reporting requirements for cars equipped with automated or driver assist systems. There was also some reporting out of India that Tesla had made a move sort of canceling people's deposits on Model 3s. That was seen as perhaps a precursor to selling cars there, maybe. But regardless, Tesla is a bigger story than just these two headlines that we're talking about today.
And for me, it's a decision of, do I invest based upon, do I think this is a car company or a technology company? I come down on the side that this is nothing but a car company. Again, the revenue determines what type of company it is, right? 90% of it is related to automobiles. The other 10% power storage, and maybe it's the new technology that everyone, the bulls, want to lean into, right? So the other side is, hey, this is not a car company. The cars, the automobiles are the platform to deliver self-driving cars, artificial intelligence, and everything else that we want to think about. That falls apart, though, for me as an investor, because there's other opportunities where I don't have to buy into the future promise and potential and pay up for it. Like Tesla's trading at valuations that in this market, I feel like I can get better bargains. I mean,
even after the collapse in its stock.
Even after the collapse, and like this is what I was saying. I think I shared it with Madison. Like the Mag 7 is a boy band that needs to desperately break up. It's not a singular trade anymore. It's not a and I think this is a bifurcation here. Get rid of Tesla. You focus on the Alphabets of the world. Apple situationally when it pulls back too sharply. I don't think it's a block that you can just own and hold. If you haven't been doing that already, right? I'm not advocating just go get out of what you've held, but if I'm putting new money to work, I'm going to be biased towards value and real earnings and revenue, not future earnings and revenue.
So now my gears are turning like, okay, which boy band member is Tesla compared to?
Joey Fatoni's in there somewhere.
I don't know my boy bands well enough to have the one-to-one comparisons there.
Let's take a look at shares of Whirlpool this morning, reversing earlier gains down just under the flat line here. The company maintaining its full-year outlook and saying it believes it will benefit from tariffs in the long term, with 80% of its manufacturing done here in the United States. For more on what's next for the company, we've got Mark Bitzer, Whirlpool Corporation Chairman and CEO. I'm also joined by Yahoo Finance Executive Editor Brian Sozzi. Mark, thanks so much for making the time for Yahoo Finance. I've heard you call yourself the canary in the coal mine for the consumer. Tell us what that consumer is singing today.
Yeah, Madison, first of all, and Brian, thanks for having me back on the show. Yes, we do have a good sense for what's going on the consumer side. Just to put it in perspective and also relating back to my prior speaker, Bob, he was talking about the bookings a couple months out. Our order pipeline typically is 6 to 8 days. So we get a pretty fast sense in terms of what's happening with consumer sentiment. And what we saw on the consumer side in Q1 is actually, even coming out of election, there was actually quite a bit of a positive spirit out there. Consumer confidence was not bad. Actually, we saw a very strong sell-through in discretionary sales. And I think amidst all the uncertainty, which we all experienced, kind of starting mid-February and continuing, consumer confidence has dropped and the discretionary side of demand has dropped quite a bit. So what we do see right now is a strong replacement demand that has kept up very strong since COVID. But the discretionary side, yeah, it took its toll, and right now we don't see it even in Q2 so far recovering.
Mark, good to see you as always. Just hopped off your earnings call that ended a little while ago, listening to it live on Yahoo Finance. Very excited about that for the first time. You sound pro-tariff. Why?
Well, ultimately it comes down to we're a U.S. producer. I know there are many companies who now talk about reshoring, onshoring. We never left. And what I mean with that is more than 80% of what we sell in the U.S. is produced in the U.S. We have 10 large factories in the U.S. We have a long heritage of producing in the U.S. Actually, it's only 5% of our sales actually come from Asia. So we are a U.S. producer. So are we faced with some headwinds? Yes, but they're manageable, large on the component side, and what we refer to in our earnings call, the loading which we've experienced by Asian competitors. But ultimately, as a U.S. producer, we will benefit from it. And that's why we're pro-tariff in terms of, but I want to clarify, we're not asking for an exemption. We're not asking for subsidy or gifts or handouts. There are some loopholes which exist in the tariff landscape today, which we just want to be closed, and then we're all good.
How do you mitigate the impact of tariffs?
Again, there's a manageable amount of tariff headwinds, and we enlarge on the component side and the preloading. So the mitigation so far has been, we had a number of price increases over the course of the last 12 months, which helped us mitigate the cost impact. The other part is we doubled down on cost takeouts. We kind of, in particular after January, we started, we've always been cost disciplined, but we kind of really doubled down on our cost takeout efforts on the variable product cost. And yes, there's some what we call rewiring of our supply chain, which occurs right now. It is limited because we're a U.S. producer, but on some components which we so far sourced in China, yeah, we're looking at where else can we source them. There's sometimes limited supply base. And we have a very limited amount of finished goods coming out of Asia, which we're also trying to rewire supply chain. So these are, by and large, our mitigation actions on the headwinds. But again, I want to point out, once the tariffs fully kick in, we do expect some tariff tailwinds benefiting our U.S. production.
I understand what you're saying, that you're not fully exposed to tariffs and therefore you're a bit immune, but historically you have still raised prices even on non-tariffed products. If we take a look at a historic example here, we have the administration's tariffs on washing machines specifically the first time that the president was in office. And even though that obviously impacted washing machines, we also saw you lifting the prices for dryers at the same time. And as you know, that means consumers did bear the brunt of that policy impact in terms of prices. If we see similar tariff measures imposed this time around, should we expect a repeated dynamic here where you lift prices on some of those goods even if the tariffs don't require you to?
Yeah, Madison, I'm glad you raised this 2018 washer tariff story because I think honestly it's time to debunk that myth. And let me explain a little bit. Because what Red refers to is a research, and there's some internet articles which came out. Apart from a database, because it's largely CPI based, and in today's world, we only look at online pricing. But here's the story. The story on these articles was, well, the tariffs in 2018 raised prices and consumers paid for it. So here's the real story. Once the tariffs came into play, the Asian producers were caught by surprise and finally started putting factories in the US. They didn't do it before, they didn't do it after. So of course there was initially a shortage that drove to an increase of prices for a very short period. Once these factories came online, the prices actually came down to pre-tariff levels. Then subsequently, and this is what the studies got completely wrong, the prices raised again. That was obviously, why would the price all of a sudden raise 2 years after the tariffs came into play? Simple reason, there was a thing called COVID, where nobody had supply. So yes, during COVID, prices raised. Now, the more relevant thing, and I think this is getting lost in all this discussion, and it's important to set the record here straight. So now we're 7 years after these tariffs came into play. So today you have 2 factories more in the US. They're competitive factories, but there are 2 factories more, which didn't exist before. And again, after the tariffs, no Asian producer ever opened a factory again. So it was during these times, so 2 factories more, and the prices are down to 2014 level. Now, how many products do you know where the prices are back to 2014 levels? Honestly, I wish eggs would be on the level of 2014 prices. So today, from that perspective, consumer pays less than 10 years ago or same, and we have two factories more. So in my view, call me pro-tariff, but in this case, the 201 tariffs back then worked.
Yeah, good luck with that egg call out, Mark. I don't think they're going back to 2014 levels. But let me ask you this before we let you go. So you make products around the world. You have 25 locations, if I'm correct, 16 countries, 10 manufacturing plants in North America. Is what's happening on the tariff front, are you more inclined to tell your board, hey guys, I want to build 2 more plants in the United States, and if it takes 5 to 7 years, so be it, I need this capital. I mean, are you more inclined to just close those other sites?
Yeah, so Brian, first of all, from a global footprint, our factories are largely region for region. So basically what we sell in North America is produced in North America, what we sell in Latin America is produced in Latin America, same for Asia. So that gives us already a natural tariff hedge. Right now, in particular, as it comes to North America, honestly, we have capacity. Right now, I would say our factories are underutilized. We had to make some difficult decisions in the past. So we have real capacity to fill it. And that, I think, in this broader tariff discussion is a big difference to other industry. This is an industry where you have US production. So I understand it's different in other industries where you might not have production. We have production, we have capacity. Now, to be also clear, and this is maybe coming back to some previous comments made, once you have predictability on tariffs and stability on tariffs, yes, I think we would double down on our investments in the US. Actually, we spoke with the administration and we laid out some clear commitments which we would do above and beyond what we have already in the US. And I do see a significant potential surge on production in the US.
Mark, thank you so much for making the time. Whirlpool CEO Mark Bitzer, and of course Yahoo Finance's Brian Sozzi for bringing us the conversation. Thank you both. Southwest Airlines pulling its full year 2025 and 2026 guidance, citing macroeconomic uncertainty. The company saying it is difficult to forecast given recent and short-lived booking trends. The carrier also planning to reduce flying capacity in the second half of the year. Joining us now, Southwest Airlines CEO Bob Jordan and my Morning Brief co-host Brad Smith for the interview. Bob, great to have you on with us. I want to get a sense of the degree to which these results were driven by the economic uncertainty caused by tariff policy. If you had to put a percentage on it, how much of your results were driven by the uncertainty caused by these tariffs?
Well, first, I'm really proud of the execution in the first quarter. We had terrific operating results. We really beat our cost plan. We had good revenue results. So all of our initiatives are on track, so the company is doing great. But no, we were highly impacted on the demand side by the tariffs and then just the consumer confidence erosion. When we started the year in January and had our expectations for the first quarter and the second quarter, since then, the first quarter fell off about 3 full points, and the second quarter has fallen off about 6 full points compared to what we thought in January. So that gives you a good indication of the level of impact on demand and just how rapidly the decrease in demand fell.
And so with that in mind, Bob, as you think about the difficulty right now it is for you and your airline peers to really forecast in this environment beyond what the bookings look like for the next 60 to 90 days, just take us into the modeling and how you and the team are going about that.
Well, first, you've got to come into something like this in a strong position. We have a strong balance sheet. We have net cash, not net debt. We are very well positioned. We already had very low capacity for the rest of the year. So you've got to come in prepared because ultimately, looking forward, it is really hard to predict what bookings will look like. The other thing is we have a really strong transformational plan. Cost levers, a lot of revenue levers. This past quarter, we turned on Expedia as a distribution channel. We started optimizing and dynamically pricing our Rapid Rewards redemptions. Coming up here in just a few weeks, next month, we've got our bag fees that'll come online. We are preparing for the extra legroom and assigned seating. We start to retrofit our first aircraft next month. So the good thing at Southwest Airlines is we have a plan and a set of initiatives that will fight against this environment, and those are unique to Southwest. So we are very well positioned. You know, the macro is going to do whatever the macro is going to do, and we are focused on what we can control, which is executing our initiatives, having a strong operation, and then really strongly controlling our cost base.
Within that, what are the realities of that capacity control that you're kind of evaluating right now, as it seems the rest of the industry is using that as one of its levers where it can perhaps take the cost of flying out of the equation, at least in this interim uncertainty?
We already had low capacity plans for 2025. We were planning to grow between 1% and 2%. We've cut another 1.5 points out of both the third and the fourth quarter, really taking out those lower demand off-peak flying. And you do that early, because if you do that early, then you can take out the costs that are associated with those. So we'll have very low capacity this year, and all of that growth is funded by initiatives. We're taking 5 minutes out of every turn in 19 stations right now, and that basically and effectively creates extra new aircraft, and that's what's funding our growth. So all the growth is funded by initiatives. But no, we have a very low growth profile, which makes perfect sense in this very uncertain demand environment.
Bob, we've heard from several other CEOs over the course of the week, both in terms of our programming and other networks reporting that other CEOs, specifically in retail, have been meeting with President Trump at the White House, speaking about the negative impact of these tariffs. Have you scheduled a call with the White House? What are your comms looking like with administration officials?
We were speaking to the administration a lot on a number of fronts. On this, on work that's underway to really modernize the air traffic control system. That'll help the whole industry in terms of efficiency. But no, we're talking to the administration often on this and other topics.
You know, with that in mind, what are you hearing from the administration on safety of air travel? And we know that for some of the headlines that consumers will see and that much of the flying public will see, it does insert, once again, the reality of, okay, yeah, there are things that we have to, of course, keep our head on a swivel around, but there is so many requirements that come into place for everything within the air travel experience, from the flight hours that a pilot has to take in order to even pilot a plane, and then for all of the safety mechanisms for passengers as well along the way to be in compliance with the travel experience for everybody else. How are you navigating what consumers are feeling right now in the first quarter and coming off of the first quarter of this year of some of the unfortunate headlines around air aviation?
Well, you start with air travel is the safest form of travel on the planet, and just start there. You know, there are opportunities to improve, of course. But it's a very, very safe form of transportation, safer than a decade ago, safer than 2 decades ago. What we really need is investment in the air traffic control system. That's both staffing and then it's modernization of the systems that are used. I've spoken with Secretary Duffy a lot, and I'm very encouraged by his focus on modernizing the air traffic control system and getting the funding to do that, making that funding stable, and then really making progress in terms of modernizing the system. We need to lead the world in the efficient way that we can use the system that's available to us.
You know, Bob, I want to come back to something that you mentioned a moment ago, and I know we're limited on time, so we got to go rapid fire here, but you mentioned the bag fees. That makes everybody's ears perk up here a little bit. Why was this the move to decide to make right now, and just how much of an additive to the financial performance do you project that it could be?
Well, it's a collection of things. It is introducing a new basic economy fare. It's bag fees. It's introducing flight credits that now expire. It's introducing extra legroom section to derive more revenue. So that whole combination is expected to generate an incremental $1.8 billion in EBIT from those initiatives here in 2025 and $4.3 billion in EBIT in 2026. So it's very, very meaningful in terms of contribution to the financial side of the business. At the end of the day, we've got to offer the products that our customers want, and we've got to meet the financial returns that our shareholders expect. With bag fees, the good thing is for our customers, especially our most loyal customers, the product that they see in a lot of cases will actually be better. They'll have access to the seat map. A credit card holder will get a free bag. A customer that has tier level will get a free bag. So in a lot of cases, this is actually better for many of our customers. But no, you've got to drive the right level of revenue production. We have always led the industry in terms of our financial performance, and we are going to lead the industry again.
30 seconds left, Bob. There's evidence in consumer sentiment data that what consumers and your customers want the most is for these tariffs to go away. What is your message to the administration specifically about these tariffs?
Well, the tariffs, there's a lot of focus on the impact of pricing in terms of the tariffs. I think the biggest thing right now is the impact on the economic uncertainty and therefore the consumer uncertainty. That's the biggest impact of tariffs at this moment, because we need that uncertainty to go away so that we can return to the right level and correct trends in terms of travel. Travel is incredibly important to the economy, and this level of uncertainty is making it very difficult to predict, and it's very hard on the economy.
Bob, we've had you here in studio before. You're not a height challenged person. You're telling me the seats are going to get smaller, larger. What's happening?
No, the seats are not getting smaller.
Okay,
I
thank
assure
goodness.
you. We're going to have terrific seating and spacing for everybody. We're simply adding a section of the aircraft that is now premium extra legroom, and I cannot wait for that day to come. We'll be selling that in the third quarter, operating that in the first quarter of 2026, and again, we are beginning to retrofit those aircraft starting next week.
The fallout from President Trump's sweeping tariffs making its way into earnings season. Southwest, American Airlines, and Alaska scrapping their full-year outlooks on Wednesday, blaming uncertainty in travel demand. Meanwhile, faced with higher supply chain costs, PepsiCo says it no longer sees profit growth in 2025. Meantime, Merck expecting to lose at least $200 million to tariffs. That's not including those additional pharma levies here. Still with me, we have Joe Brusuelas to talk about this a little bit more. Joe, I keep hearing my sources who are markets guys telling me well, the earnings, it's coming in better than we thought. It's all fine. As an economist, how are you reading these earnings?
No, and no.
Yeah.
Okay, no forward guidance is the problem because the economic environment is far too uncertain to make confident projections. I forecast in with the Wall Street Journal's panel. I'm on the board with UCLA forecast. Right now, you just can't do it with a measure of confidence. What you have to do is what they did at American Airlines. You talk to your investors with the adequate and appropriate measure of humility. We just can't project right now. What you're going to see, though, is that uncertainty real quick will extract a powerful economic cost. You're going to see orders begin to ease. Even in that durable goods orders this morning, what you saw ex-transportation, of course, Boeing orders were up 139%. Ex-transportation, they were flat. Again, tip of the spear.
Yeah.
You're going to see a lot more of that going forward. So I actually, when I hear a CEO say, look, it's just too uncertain, that gives me a little bit more confidence in them. I wouldn't really be talking about Q1 earnings, though. That's not, I think, a good place to be right now.
Well, we got to talk about what we're seeing on the tape right now. You're looking at gains, a huge relief rally, especially in the tech stocks here. You've got your NASDAQ up nearly 1.6%, your S&P 500 up over 1%. All of this rally really gaining steam off the back of Fed speak. Governor Chris Waller saying that the job market could prompt faster than expected rate cuts. Joe, is that something for the market to rally off of? Or is it a sign that we're going to have a recession and then they're going to have to cut?
Yeah, there's a lot more hopium going on in the market today than I'm comfortable with. It looks to me like Governor Waller's trying to have it both ways, right? He's signaling, this is probably going to cause a recession and we might have to cut earlier. But hey, the president can say whatever he wants. We're going to have our central bank independence. Oh, and by the way, the internal inconsistencies you're seeing here, that's okay.
And where does that leave us in terms of the outlook for the economy?
All right, so the economy is going to slow. At best, it's going to grind to a halt. At worst, we're going to be in a recession. I think we have a very mild garden variety recession, something that goes on for 6 to 9 months. To have a much deeper, broader recession, we'd have to have more profound policy errors than the ones we already have. Look, if we're going to avoid a recession, the administration's going to have to beat a hastier retreat on the tariffs. They're going to have to find a face-saving way out of this. Right now, it doesn't appear that way. The real problem, Maddie, is they can't get their story straight.
Right.
The internal inconsistencies across macroeconomic policy inside the administration is really what's damping financial markets, and it's spilling over into the real economy. We just heard from Whirlpool and Southwest basically telling us the same thing, right? The CEO of Whirlpool was my favorite. He's pro-tariff, and we're mitigating tariffs by raising prices. Okay, I'm sorry, that's not mitigation. That's raising prices, and that's going to tell you what's going to happen once we get the price shock that's going to show up in the next 60 to 90 days, that's going to cause consumers to say, my disposable income just turned negative, I need to pull back.
Chipotle mixed expectations in its first quarter results as the chain navigated lower consumer confidence and President Trump's trade war. Joining me now is Chipotle CEO Scott Boatwright. Scott, thanks so much for coming on.
Hi, Brooke, and thanks for having us on today.
Scott, let's just set the scene here. The Conference Board's Consumer Confidence Index showed that consumers' expectations about the economy hit a 12-year low. The IMF lowered its expectations for U.S. growth, and all major indices are down roughly 2% this month, if not more. Is all this noise what led to a major slowdown in same-store sales growth for Chipotle?
We certainly think so, Brooke, in large part. We saw the underlying kind of trend step down around the February timeframe. That continued into March for us. As we look at our consumer visitation study, and we talk to consumers broadly about what is causing them to be on the sideline in this economy, it's really trying to save money, uncertainty around what's going on with the global economy, certainly concerns around eating out more or eating at home more often versus eating out. As we dig into specifically what's going on with the Chipotle consumer, we're not seeing a loss of customers. What we are seeing is a convenience challenge, meaning we need to build more restaurants as quickly as we can to get to our 7,000 restaurants in North America.
Now, Goldman Sachs wrote in a note this week that as tariffs go into effect and consumers start to see prices rise on everyday goods, that it now expects growth to slow down from there. A bowl with guacamole, my go-to order, half premium. It costs about $15 here in New York. How does Chipotle compete in this sort of environment as more consumers are turning to fast food?
Chipotle today, the average cost of a chicken burrito or a chicken bowl is still under $10 nationally, Brooke, which we think is still an extraordinary value compared to our peer group. We are a 10 to 20% discount to QSR today, and oftentimes a 10 to 20% discount to our fast casual peer group. So we think about value differently, and we think about value as really high quality ingredients delivered with great classic culinary techniques in abundance and at affordability and a price point that is unmatched.
But Scott, we did see foot traffic drop 2.3%. That was the first decline since 2022. Is that enough to get consumers back in the door here?
We believe so, Brooke. And so we're going against some really tough compares this quarter. As you probably well know, weather has been a challenge for us in the first quarter. The shift of Easter moving 3 weeks later in the year is a challenge for us. Typically, we see the boom or the boost of burrito season happens right after the Easter holiday, which we did see a nice pop in our business on Monday following the Easter holiday. So it gives us a lot of confidence that our strategy is working. We're meeting the consumer where we are. Given we took a look at our brand tracker, which measures how we compare against our peer group in 20 to 25 different perceptual drivers, I'm happy to report we hit a record 15 top 3 categories this year, which shows us that we're improving in a lot of brand metrics. 2 that I'm most excited about is cares a lot about the customer and great customer service. We showed up in the top 3 of those categories for the first time.
Scott, are consumers pulling back on ordering sides?
No, we're not seeing side attachment per se drop. What we are seeing is the frequency drop. So consumers are still spending. They're still getting their favorite sides, their add-ons, whether that's guac or our delicious queso or chips. Our chips are handmade every day in the restaurant. They're still an incredible value as we see them. So we're not seeing attachment slip. We're just seeing frequency of our customer. Again, we don't have a customer issue. We have a frequency challenge.
I do want to talk about that guacamole. We did see food costs increase during this quarter for Chipotle due to inflation. We know that about 50% of Chipotle's avocados are sourced from Mexico, of course, exempt right now with a USMCA agreement. But there's so much uncertainty day to day. Will consumers see higher prices for guacamole?
Not anytime in the near future, Brooke. Our position today as it stands, I said this earlier in the year, is that we are not going to take price in this environment, given where the consumer is, until we understand what's actually happening with tariffs. We need to understand which components of the tariffs today will be transitory, which will be permanent. And we'll take a pricing action when it's right and appropriate, Brooke, but it is not in our purview today and not on our radar anytime in the near future.
Your CFO did tell investors last quarter that if there was a permanent hit to the business this year in the form of inflation, that you guys would consider pricing. It sounds like potential pricing is still on the table if these tariffs stay in effect. Is this a permanent hit on the business, and do you raise prices from there?
You know, we would have to evaluate where we sit when that actually happens, and we understand the tariff impact. Once we have that understanding, we'll take a hard look at where the consumer sits today. We have pricing power at Chipotle that I believe is unparalleled. And we view that pricing power as an asset. And we can choose to spend that asset when we want to, given the strength of our balance sheet and the strength of our economic model that gives us the opportunity to be patient, do what's right for the consumer, do what's right for the brand, and make those decisions at that moment.
So, Scott, to be clear, even though you did see same-store sales decline, you did see foot traffic decline, you still think that Chipotle has pricing power here?
I absolutely do, especially given the value as it relates to our competitors within the space and how we think about pricing in total. I know many of the brands that are competitors within our space have franchise communities that take action on pricing at will. We, being wholly owned and company owned, both here and in Western Europe, control our pricing strategy. We control how we create value for the consumer, and we don't take that lightly. And we'll lean into the right decision and the right action for the consumer at the right time.
I do want to quickly hit on tomato. Tomato salsa is also in my go-to order here. Mexican tomatoes are expected to see a roughly 21% tariff starting mid-July. How much of a headwind is that for your business?
It's small numbers in basis as it relates to basis points impact to margin. And again, something we can absorb if those tariffs go into place, and something we can price against later down the road when the consumer's in a better place. We expect this year to have somewhere in the kind of low single-digit commodity inflation as well as labor inflation. We have said historically our pricing actions have often been only to offset inflation that we're seeing in the business, not for margin capture. And so we'll look for other offsets within the P&L to offset some of those margin impacts first before we lean into pricing as a lever.
Looking out, you do expect same-store sales growth to now come in the low single-digit range. That was lower than your previously set expectation. Why are you doing that, Scott?
Just given what we experienced in Q1, the tough compares we're seeing in Q2 today, we do have, based on our forecast, we will return to positive transactions in the second half of the year. We also have several activities that as it relates to what I call the consumer flywheel. So think operations, digital, and marketing. We're going to lean into the consumer in a more meaningful way this summer as it relates to marketing and digital ad spend. Typically, it's a month where we don't spend as much as we do in the other parts of the year, so think spring and fall. And we're going to try to target our consumer to remain relevant throughout the summer months. And the summer seasonality has been a step down in the business for us for the last couple of years. So we're going to lean into streaming channels, social media channels. We're going to lean into this idea of using our most influential Chipotle users and how they Chipotle on a new campaign we're bringing forward. We're going to lean into innovation as it relates to the menu as well. So you could see a new sides or a new dip this summer as we think about how do we stay relevant, visible, and loved by the consumer throughout the summer time frame. I have a lot of confidence in the back half of the year as it relates to the LTO that we'll bring into the fall. So I have confidence we can get back to positive transaction and positive momentum in the second half.
New LTO, new dips. These are all things we're excited for here, Scott. I do quickly want to hit on the stock price. Investors are weighing the potential risks like that exposure to avocados, the intense competition, and then this overall economic environment that we're seeing. Shares are down roughly 19% year to date. What is your message to investors here?
You know, I would tell you that the strength of the brand has never been better, Brooke. I've been here 8 years now. We are absolutely on our front foot as it relates to operational, as you think operational ability. If you think about culinary, we're delivering world-class culinary across the system today. The throughput numbers continue to improve. Our customer experience numbers, all metrics we look at continue to improve. We're delivering better in-restaurant experiences. The marketing calendar slated for the back half of the year and into 2026 has never been stronger. We continue to innovate in our digital properties as we think about customer journeys, individual personalization, and how we bring that experience in a frictionless way to the digital consumer. So I have a lot of confidence in our strategy, how we move forward as a brand, and I think there's never been a better time to be a part of the Chipotle family.
Scott Boatwright, Chipotle CEO, thanks so much for taking the time today. Appreciate it.
Shares of Pepsi trading lower this morning after the company's first quarter earnings came in below expectations and trimmed its outlook, citing tariffs and pressure on consumers. Joining us now to break down these results, we've got Nick Modi, RBC Capital Markets Managing Director, who has a price target of $163 a share and a rating of market perform on the stock. Great to have you here with us, Nick. So just take us into your analysis that you've got on PepsiCo right now.
Yeah, I mean, look, we were cautious coming into the quarter. We've been cautious on PepsiCo. You know, their North American beverage business has been under pressure for quite a number of years. They've been losing share pretty consistently with Coca-Cola, but their snack business was really performing quite well, and that really started to slow down going back to late last year and kind of rolling into this year. And that's really what's putting a lot of pressure on their margins and their earnings. It's hard to see at this point, just given all the consumer uncertainty, that that's going to turn anytime soon. I think it's going to take some time. And remember, they took a lot of pricing, and they also took some chips out of the bag. And I think consumers are noticing. And so consumers are making different choices. We're seeing private label across the snack category actually have a lot more traction than what we'd normally see, even during recessionary or economic kind of constrained environments. So I think there's some wood to chop here, and that's partly why the numbers had to come down.
And given what you're laying out in that kind of backdrop for Pepsi, I know that they're essentially expecting no growth over the course of this year in terms of their latest guidance. Could it potentially go in the other direction? Could you see a decline over the course of this year?
You could. It really does depend. I mean, I think we can all agree that visibility is not very high right now for anyone. Mm-hmm. And so I think if the consumer does get worse, which, by the way, we believe that will be the case, that could definitely drive some downside. And also we have some other geopolitical actions or policy changes that puts even more pressure on their cost structure, like food ingredients, as an example. That could be another driver that could weigh on their results overall.
Do you think a worsening consumer environment is already priced into the shares right now?
Yeah, I mean, we've been quite cautious. And remember, Pepsi has really been under a lot of pressure on a relative basis. So I think many investors have also been kind of bracing for the outcome that we had today. So it feels like a lot is priced in. But again, given the lack of clarity and lack of visibility, and given the fact that they're losing share in their biggest, most profitable business, we need to get comfort that we're going to hit a stabilization point or an inflection point at some point. And it doesn't seem like that's really in the near term right now.
And Nick, I think it's important to note, and I imagine you'd agree with this, that it's not just the tariff and economic uncertainty. Another headwind among many is the GLP-1 usage uptick and the impact that has on things like snacking and soft drinks. To what extent do you think that there are other headwinds for this company that can't be addressed by a tariff negotiation?
Yeah, I think the GLP-1 is fair. I mean, we believe what's going on with PepsiCo is much more cyclical or economic related than GLP-1. We've done a lot of work in this area. I know that might be a contrarian viewpoint, but that's kind of what our analysis would point to. Then we have potential implications of not being able to use SNAP, or formerly known as food stamps, to buy carbonated soft drinks. So that could potentially be an issue. There's a lot of states that are coming up with state level regulations that are calling for that. So there's you have the food ingredient dynamic and what's going on with RFK Jr. In terms of taking out food dyes and potentially other changes down the road. So, there's a lot of wood to chop. And earlier this week, we put out a report basically urging and encouraging all of our companies to cut their earnings forecast significantly, because I think they need that flex on their earnings income statement to invest to deal with a lot of these changes, but also provide benchmarks and targets that investors can have high conviction in. That's the beauty of the consumer staples industry, is that when things are tough, investors really like to buy these stocks, but we're just not seeing it happen to that degree this cycle because there's so much earnings risk.
And Nick, if things are tough for consumers, what we've typically seen in the past is that they will flock to where they can get the best discounts and deals, and typically that has meant buying in bulk, and we see surges in places like Costco or Walmart Sam's Club or BJ's Wholesale. Are those bulk buyers enough in the interim period to at least buoy or save to some extent Pepsi and their competitors' financial performance?
Yeah, I don't think it's enough. And here's really the way you have to think about it. Buying in bulk is value shopping for higher income consumers, right? Because they're able to actually outlay the capital and they get a lower price per ounce. But if you're a lower or middle income consumer, you may not have all that capital to buy in bulk. And you might not even have the space because you're living probably in a smaller living area, right? And so I think really what's happening right now is that this is a middle, lower income issue that is starting to have some impact on higher income consumers because the stock market is under pressure. And so the combination of the two is obviously, why we've been so cautious and think things will get worse before they get better.
Shares of Boeing rising after the aviation giant reported a narrower than expected loss for the first quarter as it expects to reach the maximum production of 737 MAX aircraft later this year. While these results do not include any impact of tariffs beyond March 31st, CEO Kelly Ortberg saying the company has the flexibility needed for the current macro environment. Joining us now to break down these results, we've got Tony Bancroft, Gabelli Funds Portfolio Manager in Aerospace and Defense here. Tony, good to see you here. So, one of the things that was really catching the street's attention here, it seems, around Boeing is them petitioning to be able to get production back to peak or ramp up production more fully around the 737 MAX line here. If that is the case, what would the pass-through look like for Boeing's financial performance, and how immediately would you expect to see that?
Yeah, it's great to be back. I'd say the 38 a month rate cap is probably the critical component to Boeing's cash flow performance going forward. They're just right now they're just subscale. They're not able to utilize the operating leverage that they have with that installed base of infrastructure, and until they really get back to near that 38 a month, they're gonna be struggling. I think over the next few months, hopefully we'll see some good news. Obviously, so far this week we're seeing good news, and from last week as far as this morning the earnings release and them talking about a steady rate increase in production. They're still confident with the 38 per month they can get by the end of the year, and then the wins on the F-47 in defense, and then just overall stabilization of the business is all good signs.
Tony, how good is this news? Is Boeing fully out of the woods in your view?
I think it's incremental. Obviously, this tariff issue is still going to be a headwind until there's some resolution. Obviously, Boeing exports 80% of its of its products internationally, and I think there's a lot of moving parts in there. Of course, countries that are potentially doing retaliatory tariffs like China. They have their own issues. They need these parts. 40% of their fleet is a Boeing aircraft. They're trying to make their own aircraft, the COMAC, which is essentially a Boeing minus, a 737 minus, using all mostly U.S./Western highly engineered aircraft parts, including engines. So I think Boeing still we have to work through that. But in the near term, this is definitely positive incremental news, especially with the cash flow burn is not as bad as people expected.
How significant is Boeing selling parts of its business, or at least the part of its business that it recently identified that it would do just fine perhaps with doing away with, or at least having someone else own that asset? How much does that give them some breathing room financially and on a capital basis, and how long do they need to stretch that for until they are able to ramp production back up for some of the most embattled parts of its fleet production, and then secure more orders along the way?
Yeah, that's a good point, Brett. I think Boeing CEO Ortberg has been very direct about getting off of these sort of non-core businesses. Boeing's an aircraft maker, right? They build large commercial planes, and they have a defense business where they build fighter aircraft. As far as the Jepsen digital pub business, it's a great business. I mean, I used every pilot in the fleet. Every pilot has to bring pubs with them, and obviously there's a digital version now. But it's a great recurring business, but it's not really core to their operations, and there's probably a better owner for it. I think maybe the space business, there's probably going to be some thought process going into that of, even though I know CEO Ortberg talked about getting more Starliner launches this year, I think in the long term, do they want to be competing with SpaceX in that business when it's probably not as core to them? So I think it's important that they get some cash in the balance sheet, pay down some debt, and then focus on their core operations, which is building essentially the 737. They've got to get that at rate.
Tony, we got just about a minute here. I would be remiss to not ask you about the roaring market rally that we are experiencing at this moment because of, in part, this Wall Street Journal exclusive reporting on the Trump administration considering slashing back those proposed tariffs on China. As you can see, your S&P up over 3%, your tech-heavy NASDAQ now up over 4%. I know you focus on aerospace and defense. Just how big of a deal is it for that sector specifically if we do, in fact, see a rollback to this degree that's proposed in this reporting?
Yeah, Matt, it's definitely a big deal, but I think sort of taking the next layer, aerospace and defense is somewhat specific here as far as, it's a secular growth industry. It's got Boeing itself has a 6,000 plane backlog, a decade-long backlog by both OEMs, and people are flying more. That's just the reality. And I think the bigger issue is these planes it's a razor blade business where these planes need to be serviced and maintained, and you need to get new planes. The efficiency improvements in newer planes should drop right to the bottom line of these airlines, and more of the world is flying. So I think in the long term, the world's going to need these planes, and tariff, no tariff, this is sort of a demand that's just unconstrained right now, and it's probably continued to be for quite a while.
Tony, thank you so much. Appreciate it. Well, ServiceNow benefited from the government's cost-cutting push during the first quarter with revenue and earnings that beat the street's expectations. The company also offering strong guidance, signaling solid demand in the software space. Joining us now with more, Gina Mascantuno, President and CFO of ServiceNow. Gina, great to speak with you. Thank you for making the time this morning. This stat really stood out to me, 30% higher sales in the public sector. Explain to me how a government efficiency push is driving an increase in government spending at ServiceNow.
Well, thanks so much for having me here, Madison. So first of all, I'm just so proud of the team and the execution to deliver this incredible quarter. So it's all about elite level execution at this rate and AI acceleration, which really helped us deliver that outstanding quarter. We beat our guidance on all top line growth and profitability metrics, subscription revenue at 20%, backlog at 22%, EPS up 18.5%. So a solid quarter across the board. And yes, really proud of our public sector growth at 30%. And you're exactly right. Federal agencies are really focused on modernizing and elevating how they serve the government, the American people. And what I would say is that driving outcomes, improving auditability, and eliminating millions of hours and dollars is exactly what the ServiceNow platform helps them deliver. And so now more than ever, these government agencies really need a tech platform that helps simplify the complexity and lets them become digital first. And that's exactly what the ServiceNow platform enables.
And Gina, every time I speak with you, I'm reminded of being at the Goldman Sachs conference and seeing a table filled with VC folks, all of them mentioning that this was their top pick stock in the AI space in particular. Talk to me about how you are viewing this particular moment in terms of AI and customer demand amid a lot of uncertainty about whether or not the CapEx on AI is going to prove out as a good investment moving forward.
Well, I think right now, more than ever before, leaders are so focused on the future, and they're really focused on growth in and cost out. And so demand for AI capabilities, even despite the economic uncertainty, everyone is focused there because they know if they are not transforming, they're going to be left behind. And so we're absolutely seeing demand for AI translating into real transformation for customers. And so our AI products, we call them Now Assist, our net new ACV exceeded expectations once again, and this is still our fastest growing new product ever. And so we talked about a little bit on the call about our deals quadrupling year over year, and the average deal size is growing over a third quarter over quarter. And this is after our very strong and bigger Q4. And so it's not just about AI, though. At ServiceNow, 19 of our top 20 deals included 5 or more products. So it's about core plus our growth areas like AI continuing to do well.
Looking ahead, Gina, to what extent are you concerned that any kind of economic slowdown could start to impact ServiceNow moving forward? How are you thinking about that?
Yeah, well, I think if you just take a look at our guide, it really shows the economic resilience of the ServiceNow platform. You know, we raised our guidance at the midpoint for our revenues, and that's really because we're coming from a position of strength and momentum. You know, demand signals remain strong. And again, the customers we're talking to are really focused on today, but as importantly, focused on the future. And so I think we also were able to take a prudent approach that let us factor in some potential risks ahead, especially as it relates to the federal government, while at the same time allowing us to raise the guide. And so that really just demonstrates the economic resilience that this ServiceNow platform has for our customers.
And Gina, lastly, Guggenheim out with a note this morning pointing to 2 things in the guidance here, that new business did come in slightly below their expectations, and also that the guidance may not be as strong as first appeared due to some FX related gains. As the CFO, how are you thinking about those currency headwinds and new business as well moving forward?
So our new business actually grew ahead of our expectations and allowed for that very strong beat on our current backlog. We beat that by 150 basis points. And so our new business was very strong. And we were very clear about the currency tailwinds in our guide, which allowed us to de-risk some of the back half of the year based on the potential economic uncertainty. But again, I was super clear that we are seeing no slowdown in demand and really just focused on a prudent approach as we think about the guide.
Yeah, making you an outlier this morning with a lot of demand slowdown coming out in earnings calls, Gina. Thank you so much for making the time. Appreciate it.
Thanks so much.